Chapter 14, Leverage and Margin. Section 5, Responsible Leverage. Responsible leverage means treating leverage as a tool, not a shortcut. It should fit inside a clear risk plan designed to protect your capital, limit drawdowns, and keep you in the market long enough to benefit from good decisions over time. Leverage becomes dangerous when it tempts you into a position that is too large for your account and your stop-loss plan. At that point, even a small market move can turn into a fast loss, put pressure on your margin, and force you out before your strategy has a fair chance to work. A good place to begin is with risk per trade, and many traders use the 1% rule as a simple guide. So if your account is $10,000, your maximum planned loss is $100, and leverage does not change that limit because risk is based on the stop loss, not the margin required to open the trade. Once you know how much you are willing to lose and where the stop goes, you can calculate the biggest position that still fits the plan. If your risk is $100 and your stop is 5% away, the largest position is $2,000, and only after that do you decide how much leverage is needed to hold it. That order matters more than many beginners realize. Size the trade first, then choose the leverage. The same position can be held with different leverage levels, and your planned loss stays the same unless leverage encourages you to increase the position itself. Let's make that concrete with a simple example. A $20,000 account risking 1% can lose up to $200 on a trade, and if the stop is $5 below a $100 entry, the correct position size is $4,000. At 5 times leverage, only $800 of margin is required. Over-leveraging shows up when borrowed buying power becomes an excuse to go bigger than the plan allows. In the same example, buying 200 shares creates a $20,000 position, so a $5 drop becomes a $1,000 loss, or 5% of the account on a single trade. Even when each trade looks reasonable on its own, total exposure can still become too large. Several positions that all depend on the same market theme can stack risk together. So, responsible leverage also means watching correlations, spreading exposure thoughtfully, and cutting size when volatility picks up. Good habits help keep leverage under control in real trading, not just on paper. Set the stop loss as soon as the trade is opened, avoid relying on a mental stop, review leveraged positions regularly, and if you cannot monitor closely, it is usually smarter to use less leverage. Often, the warning signs appear in behavior before they show up in the account balance. If you find yourself using the broker's maximum leverage, skipping stops, adding to losing trades, or ignoring costs and correlations, leverage may be driving your decisions instead of supporting your plan. The simplest way to stay responsible is to follow the same order every time, set your risk, choose a stop loss, calculate the correct position size, and then use only the leverage needed to hold it. That process keeps leverage in its proper role, as a tool inside a disciplined risk framework rather than a reason to take bigger bets.